Attention family offices and private investment firms. If your organization invests in commercial real estate secured private debt, we'd like to introduce you to what we're building at Metropolitan Builders Commercial Capital Group, or Metro BCCG for short. As of August 1st, 2026, we transitioned from operating as a commercial mortgage loan brokerage firm to operating as a commercial mortgage banking firm that is focused on originating, underwriting, structuring, and syndicating our own commercial mortgage loan portfolio. Why the change? As a broker, we could find a good transaction, analyze it, and work hard to get it financed. But at the end of the day, we were still trying to fit that transaction into somebody else's lending box. A large commercial mortgage can quickly become an all-or-nothing proposition. A workable $75 million loan may be declined simply because one lender doesn't want $75 million of exposure to a single transaction. And if that lender backs out late in the process, the borrower may already be facing a purchase deadline, expiring permits, seller pressure, a loan maturity, or costly extensions. As a broker, that experience would leave us scrambling to find another lender and restart the process with even less time on the clock. That was one of the many factors that helped shape the commercial mortgage banking model we're building today. Instead of asking, "Who can we take this loan to?" we start with a better question. Is this a loan request that should be funded? We analyze the proposed transaction, identify the risks, determine what the real estate and its cash flow can reasonably support, and structure the mortgage accordingly. Loan syndication gives us a strategic way to underwrite and fund larger commercial real estate loans by dividing one mortgage into multiple direct investment interests. We call those interests loan participation notes, or LPNs. In plain English, an LPN is simply an investor's share of a specific commercial mortgage. For example, a $75 million commercial mortgage could be divided into 20 LPNs of $3,750,000 each. One investor might purchase one mortgage share, another might purchase 4, another might purchase 8. A $75 million loan is still one commercial mortgage, but no single investor has to fund the entire loan. The mortgage determines how much capital is needed. You determine how much of it you want to participate in. One mortgage, multiple direct participants, each choosing its own allocation. Our platform is not limited to any one type of commercial real estate. That includes single-family residential investment properties, along with multifamily, office and healthcare, retail, industrial and logistics, hospitality, self-storage, mixed-use, manufactured housing. We also underwrite specialty properties like churches and schools and other qualifying income-producing real estate. We work with experienced owners, operators, developers, builders, and sponsors across the commercial real estate market. Loan amounts generally range from $5 million up to and above $100 million. Our financing can support acquisitions, refinancing, development, ground-up construction, renovations, repositioning, value-add improvements, lease-up, stabilization, and long-term ownership. Regardless of the property or transaction type, the loan as proposed has to make sense. And that starts with one basic question. What is going to make the mortgage payment? For stabilized income-producing real estate, we focus heavily on debt service coverage and the strength and consistency of the underlying cash flow. That cash flow might come from apartment rents, commercial leases, hotel operations, storage rents, healthcare operations, or other recurring property-level income. For development, construction, rehabilitation, or transitional real estate that hasn't reached stabilization yet, we look at what supports the mortgage during that period, and whether there is a realistic path to stabilized income and repayment. Property value matters, but property value by itself doesn't make the monthly mortgage payment. Cash flow does. So we look at income, expenses, occupancy, collections, leases, collateral value, leverage, sponsor equity and liquidity, reserves, physical condition, management experience, market conditions, and the realistic path to repayment. When underwriting a loan request, we review rent rolls, operating statements, construction budgets, development costs, pre-leasing, absorption, franchise or management agreements, replacement costs, and other information specific to the transaction. We also independently support the value of the collateral. Our initial real estate underwriting may use a certified broker opinion of value, or BOV, from a qualified commercial real estate firm. An MAI appraisal may also be required as part of final underwriting and due diligence. For certain transactions where the value of an operating business is also important to the credit, we may rely on an independent business valuation prepared in accordance with US PAP standards. We also stress test the mortgage to see how it may perform under different conditions. What happens if income declines, occupancy falls, a major tenant leaves, expenses or construction costs rise? What if lease-up takes longer than expected, property values decline, or refinancing conditions change? The stress points may change from one property type to another, but the principle doesn't. Good underwriting isn't just about whether the mortgage works when everything goes right. We also want to know what happens when something goes wrong. For every loan we underwrite, we look to answer 5 questions. What are we financing? What supports the value? What supports the mortgage payment? What needs to happen to the asset? And most importantly, how do we get our principal back? We underwrite the credit first. Yield follows the credit. Across our commercial financing platform, qualifying mortgage rates generally range from the then-current Wall Street Journal prime rate up to 300 basis points, or 3 percentage points over prime, depending on the credit, transaction structure, and asset class. We generally use 2 strategies to determine the length and structure of the mortgage investment. ASX stands for Acquire, Stabilize, Exit. This is our 3 to 7 year bridge strategy. Acquire it, stabilize it, and execute the exit. ASH stands for Acquire, Stabilize, Hold. This is our permanent financing strategy, with qualifying mortgages structured for up to 25 years and fully amortized. Acquire it, stabilize it, and hold it. Metro BCCG stays close to our core strength: commercial mortgage origination, underwriting, and structuring. But we don't try to do everything ourselves. We work with experienced independent attorneys, title and escrow companies, and loan servicers, so the handling of money remains separate from our underwriting and lending functions. Every closing is overseen by an experienced commercial real estate attorney. The attorney coordinates with the title, escrow, and servicing parties and oversees the preparation and review of the loan, closing, assignment, participation, and servicing documents. When you decide to participate in a mortgage, your investment capital goes directly into a designated independent transaction escrow account maintained by the applicable title or escrow company. The funds remain under independent control and are dispersed according to the closing documents and requirements. Metro BCCG does not take custody of your investment capital or require it to pass through our operating accounts. After the loan closes, an independent loan servicer receives and processes the borrower's scheduled mortgage payments. The servicer also maintains the loan and payment records, tracks balances and payment obligations, and makes the applicable remittances to participating investors. This lets Metro BCCG stay focused on underwriting, monitoring the loan, and managing the lending relationship with the borrower, while independent professionals handle the closing, escrow, servicing, and movement of funds. To put it simply, your investment capital goes into the mortgage through independent escrow. A commercial real estate attorney oversees the closing and legal documentation, and the borrower's payments come back through independent loan servicing. Just as importantly, you're not investing in a blind pool or giving Metro BCCG discretion over your capital. We originate and fully underwrite a specific commercial mortgage first. Then we present you with an investment summary for that transaction. The investment summary gives you the information needed to evaluate the opportunity, including the borrower and sponsor, collateral, valuation, cash flow, debt service capacity, loan structure, material risks, repayment strategy, and supporting due diligence. Our underwritten loan file also includes the applicable due diligence exhibits for your review and, as the transaction moves toward funding, a scheduled closing date. Because much of the underwriting and due diligence has already been completed before we present the opportunity, our goal is to make your review and decision process efficient. In most cases, that process can generally be completed within approximately 7 to 10 business days. You review the specific mortgage and decide for yourself whether it fits your investment criteria, and, if so, how much you want to participate. Once you decide to participate, you can submit a letter of intent identifying the number of LPNs, or mortgage shares, you want to purchase. That letter of intent allows us to reserve your requested allocation while the final participation and closing documents are prepared. One identified commercial mortgage. 1 independent investment decision. 1 clearly defined participation amount. From a basic participation standpoint, LPNs in private commercial mortgage banking can serve a similar purpose to CMOs on Wall Street. They allow investors to participate in mortgage debt without requiring one investor to fund the entire underlying mortgage. The important difference is how we structure them. The syndicated loan participation notes we issue are private, direct participation, closed-ended, non-securitized, short or long-term fixed income investments tied to a specifically identified commercial mortgage. These are not Wall Street CMBS securitizations or publicly traded mortgage-backed securities. We do not pool unrelated mortgages. Each LPN represents a direct participation interest in a specifically identified underlying commercial mortgage. Where an applicable loan participation note constitutes a security, the offering is intended to be conducted pursuant to Rule 506C of Regulation D under the Securities Act of 1933, subject to definitive offering documents, applicable law, investor verification, and securities counsel. Our syndicated commercial mortgage loan participation notes are only offered for sale to accredited investors. We built this direct participation platform specifically with family offices and private investment firms in mind. Your organization already has an investment box, the yields you're looking for, the types of real estate you prefer, how much you want to invest, your maximum exposure, leverage limits, investment duration, geographic preferences, and other criteria. We want to understand that investment box so we can present commercial mortgage opportunities that fit the parameters your organization has already established. So when we bring an opportunity to your organization, we're not asking you to chase a particular property type, market, or trend. We're presenting a commercial mortgage that has already gone through our underwriting process, so you can focus on one question. Does this investment fit your organization's criteria? If the answer is yes, the next step is simple. You can call our investor relations team at 1-800-457-5010 or send a blank email to our Family Office Opportunities autoresponder at family-offices@metrobccgi.com to automatically receive our introductory brochure and participation questionnaire. You can also visit metrobccgi.com/family-offices for more information and to complete our syndicated commercial mortgage note investment participation questionnaire. The questionnaire tells us what you're looking for: preferred property types, allocation size, maximum exposure, desired duration, yield parameters, leverage preferences, geographic preferences, transaction types, and other investment criteria. Completing it is not a commitment to invest. It doesn't put your money into a fund or give Metro BCCG discretion over your capital. It simply tells us what your investment box looks like so we can determine which future opportunities may be a good fit. So, if your organization allocates capital to non-securitized, fixed income, commercial real estate secured private debt investments, let's talk. We look forward to working with you.